In this video, we're going to look at Exelixis, and that's a biotechnology company located in California. And what I do in my videos is I run a discounted cash flow model to figure out what the real value of the stock is. And we also look at the financial ratios of the company and compare them to their competitors. So let's get started with the model. The first thing we need is the market cap, which is $7.2 billion. And that's the value of the company according to the stock market. And then we're going to pull the stock price, which is $23.48. That's what they're currently trading at. We also need the free cash flows, and that's the cash flow from operations minus capital expenditures. And that's how you value a company. You estimate the future free cash flows and discount that number back to today's value. We also need the net income, which is the profit and loss on the income statement. And we also going to pull the revenue, which is the sales. That's also on the income statement. So now that we have all the numbers, we need the capital structure of the company. This company has no debt, so we need to figure out the cost of equity. So we need the beta for that. And we'll go back to Yahoo Finance and see what the beta is. And it's 1.54, so that means the stock moves roughly 1.5 times of the market. Let's go back to the balance sheet to get the current assets. And these are assets that consist of cash, accounts receivables, and inventory. And that's $1 billion. And let's get their current liabilities, and these are payables and debts that are due within 1 year, and that's $142 million. Let's pull their equity, that's assets minus liabilities, and that's $1.7 billion. And also for the model, we need the EBIT, earnings before interest and taxes. On the income statement, they call that operating income, and that's $369 million. So to get the weighted average cost of capital, it's the capital asset pricing model, which is how you calculate the cost of the equity. And that comes out to 14.15%. And they're 100% equity, no debt. So we're going to use that 14.15% and discount the future cash flows. So we estimated 4 years of future free cash flows. Then we did a terminal value, which is all years past year 4. We discounted those numbers back to today's dollars, and we get a value for the company of $12.5 billion. We divide that by 307 million shares, and we get an intrinsic stock price of $40. They're currently trading at $23, so they're trading at a 41% discount, so it's a buy according to the model. Let's see what Simply Wall Street. They're even higher. They're at 54 at their intrinsic value. Let's look at the historical stock price of the company to see where they've been trading. It seems like it's been in a fairly tight range the past 2-3 years. It was below $10 5 years ago, but it's been trading in the 20s for a few years now. Let's look at their financial ratios to get more information on the company. The PE is 22. That's a little higher than what I like. That's price to stock over earnings per share. They also have a high price to sales ratio of 7.4. That's price to stock over sales per share. Their price to book is 4.3. That's price to stock over book value per share. That's a little high, but not too bad. They have a really high current ratio, so they're not using their current assets efficiently. A decent ROE, 19%. I like to see around 20-25%. No debt, so there's no interest coverage ratio. And the best way to look at ratios is to compare them to competitors, similar companies. So Exelixis and Royalty Pharma are in the same industry. And if it's shaded orange, that means the ratio for that company is better than the other company. Royalty Pharma has a much better PE at 14.5, but price to sales, they're both pretty weak. Exelixis is best in price to sales, price to book. They do have a higher current ratio, but I think it's a little too high. I think Royalty Pharma is better. Royalty Pharma has a much better ROE. Exelixis is about the average for the market. And debt, obviously Royalty Pharma is much higher in debt, but they're not too high. 50% is manageable. And Royalty Pharma is a much bigger company. So let me know what you think about the video in the comments if you have any suggestions. Thanks for watching.